Hello guys, welcome to my channel. On today's episode, we'll be talking about sports and futures trading. We'll be explaining in details what sports trading is all about and futures trading and their differences. So come with me. Stay tuned. Make sure you watch till the end of the video and you comment, subscribe and like. Share the video also because I'll be dropping more of these stuffs. I'll be dropping a lot of educative videos relating to crypto. So let's dive in on today's episode. When we talk about sports trading, what is sports trading? Because that is the first aspect, the first part every trader will definitely encounter in cryptocurrency, spot trading. Spot trading is the direct purchasing or selling of financial instruments and assets such as cryptocurrency, stocks, forex, and bonds. It comes in two forms. The first form involves two parties, while the second form involves three parties. The first form that involves two parties can also be referred to as OTC trading, which means over-the-counter trading. This form is a direct transaction between two parties, the buyer and the seller, in a situation where a buyer sends money, fiat currency to the seller, and the seller in turn credits the buyer with cryptocurrency into his or her wallet. In the other hand, the second form that has to do with third parties involves the buyer, the seller, and a facilitator. This is where this is where exchanges comes into play. Exchanges like Binance, Bybit, OKX, Gate.io, and so on. The transaction is being carried out on the exchange, where the buyer place a trade on a particular cryptocurrency pair that he or she wants to purchase, and the exchange will actually notify the seller. The exchange will facilitate the trade on the end of the seller and the buyer to make sure that the trade is successful. And once the order is being triggered, the seller's cryptocurrency will be credited to the buyer, while the buyer's fiat currency will be credited to the seller. That is the direct purchasing and selling, direct exchange. That is what spot trading is all about. Spot trading requires little or no trading skills. As a matter of fact, it's a form of trading that anybody can carry out. You need no much knowledge about the market. You don't have to come into the market with much technical skills or analytical skills. Even somebody that has no knowledge about the market can execute a spot trade. Most times, spot trade is actually used by investors, people that don't even have time to trade. People that don't have time to be looking at the chart, to be monitoring the markets every now and then. They literally buy a coin and leave it in their wallet for a long time, hoping for a huge return in the long run. One thing about spot trading is that you can only make profit in one direction. When you purchase a coin, you anticipate for the price to go up so that it will be profitable. That is the only way spot trade rewards the traders. If you buy a coin at a specific price and the market start dipping, you are actually making loss. Loss in the sense that the value of that coin is going down, but the quantity remains the same. But in futures trading, it's not like that. Futures trading is completely the opposite of spot market, in the sense that this futures, it requires much more knowledge of the charts. You have to be good at your technicals before you can be profitable in futures markets. And also futures gives us a opportunity to trade with much higher amounts than we have. For instance, the futures market provides us with leverage. Depending on the pair you want to trade, it provides us with leverage up to 1 to 100x, from 1 to 100x. Some pairs actually has less than 100x, depending on the exchange you are using. Binance actually reduce the leverage in most of the pairs in their exchange to help reduce the risk. They want to cut down the risk of the traders using their exchange, because this leverage of a thing is a double-edged sword. It can actually amplify your winning and also amplify your losses if you don't manage your risk as it should be. For instance, if you have $10, you can actually trade as one who has $100 using 10x leverage in futures. That is to say that those who have little or no capital can also be profitable using futures markets. But in sports, you can hardly make good profits using little capital like $10. Futures has a lot of features also, which I will be explaining. For instance, the margin mode. For those of you that are considering going into futures market, the cross margin and the isolated margin. You need to know what these two things is all about. Most times, if you don't know what they mean, you can actually risk all your capital in ignorance and you'll be liquidated. Isolated margin actually means exposing, like if you have $100 in your futures wallet and you are only willing to go into a trade, to place a trade with half of your capital, which is $50, you are only risk it means that you are only risking the $50 that you used to place the trade. The remaining $50 left in your balance is safe actually. Worst case scenario, if the trade should go against you and you are being liquidated, that is in the case you do not set stop loss, you will only lose that $50 that you used to place that trade. The remaining $50 will still be left in your futures wallet. That is for isolated. That's you are isolating the ones that the balance, the part of your capital that is not used on that trade. Meanwhile, cross margin is completely the opposite. of isolated. If you are placing a trade, for instance, you have, let's say you still have $100 in your futures wallet and you only placed a trade with $50. What it means, cross margin, what it means is that you are risking the entire money in your futures wallet. Should the trade go against you, in cases where you did not use stop loss, it will it will actually take off the $50 that you used to place the trade and go ahead to take from your the remaining balance in your futures wallet. In as much as you still have money left in your futures wallet, the trade will continue going against you until everything is being liquidated. That is in cases where the funds in your futures wallet is not sufficient enough to hold the trade until the market starts reversing. So while using cross margin has its own advantage, the disadvantage is much. I don't even advise any newbie that is coming into the market to trade with cross margin. It is more safe to trade with isolated margin. In that way, you can be able to control your losses and also manage your risk. That is for that on futures. And also the leverage. If you have $10 and you're using 10x leverage, you are trading like you are trading, that is like someone who has $100. You are trading as someone who has $100 account. If you have $100 and you are trading with 10x, you are trading with $1,000. You multiply your capital with the distance, the leverage size. That is one benefit. That is one good thing about futures. It gives you the opportunity to have to gives you access to more capital than your initials to explore the market. But in the other way around, if you don't control your leverage and the trade goes against you, it could also amplify your losses. That will be all for today on sports and futures markets. Also note that in futures, you can make profits in both direction. You can make profit in both market direction. You can take advantage of the upward and the downward movement of the market to profit from the futures market. What does that mean? You can actually go long if you anticipate that the market, for instance, look at the pair we have here is Waves USDT. If you anticipate that the price of Waves is going to spike, is going to go up, is going to move in an upward direction after you must have done your analysis, what do? You take a long position. You come to futures market and you buy, you take a long position, and once the market starts moving in your direction, you will be in profit. Secondly, you can also trade in opposite direction. If you anticipate that the market is going, maybe that market has been trending upward, and you feel that there is weakness in the momentum, in the volume, and you know that anytime soon that it will start going down, there will be a change in trend. You can actually short the market. You can actually short that pair. You can actually take a short position. You come to futures market and you sell. You switch from buy to sell. You place your sell position, your short position, and immediately the pair, the price start going down. You are in profit already. That is one good thing about futures. You make profit in both directions. Meanwhile, in sport, you only make profit in one direction, which means when you buy a coin, you can only make profits when the price goes up above the point you bought from. That is just it. That is just the major difference of sports and futures. Meanwhile, in sports, you can only trade with your money. Nobody is borrowing you any money to trade. You are trading with your capital, the money you came into the market with. Meanwhile, in futures, you are entitled to trade with 10 times your initials, more than 10 times, 100 times, 50 times your initials. You have the leverage to amplify your capital, which means if you have $100 and you're using 10s, the exchange is borrowing you $900 added to the $100 you have. That means your $100 with the 10s leverage, you have access to trade as someone who has $1,000. That will be all for today's. That will be all for today's class. I will see you in the next lecture. In our next video, we'll be talking about different types, different types of order in spot trading. Like we have limit order, market order, stop limit, trailing stop, and OCO. OCO. I will be explaining all these other types in our next video. Thank you for watching. Like, share, comment, and subscribe to our channel. See you in our next video. Thank you.